These big bank earnings showing some resilience amid headwinds like rising rates, bad loans. But can the same be said for regional banks, which are set to report next week? Our next guest says it could be another underwhelming quarter given the macro environment, and downside risks could remain going into 2024. Let's bring in Wedbush Securities Managing Director David Chiaverini to get some more thoughts on the topic. David, it's great to see you as always. We were just talking about net interest income. And if anything, the regional banks and the super regionals are more reliant on net interest income. The fact that these other banks seem to do well in that area, does that actually bode a little bit better for the regionals?
It does bode better, at least for the near term. Looking at third quarter results, we're expecting net interest income to come down, but be down less severe than what we saw in the second quarter. Higher for longer is going to be a headwind for the group. And I think the reason why we're seeing the banks sell off today relates to what you alluded to earlier, credit quality. Commercial real estate, when we look at PNC, their credit metrics, non-performing loans for CRE doubled in the quarter. And that's a concern looking out to next year as CRE maturities start to come through, and regional banks do have exposure to CRE. So it really is an issue of credit quality that I think is taking down the banks today, despite NII coming in, better than expected.
And David, deposits have stabilized, but banks are still going to have a tougher time just keeping depositors from chasing higher rates elsewhere. How much of a headwind do you see that in the quarters ahead?
Yeah, I think that's going to be a continued issue in the third quarter and into the fourth quarter. As long as the Fed is closer to halting its rate increases, and it looks like we are, near the end, maybe we get one more hike, then we're going to see kind of the second derivative slow down on increasing deposit costs. So we're getting towards the end in that regard. So that's the sort of bright spot. Everything above the loan loss provision line for the bank income statements should look pretty good over the next year. But credit quality is kind of the overhang.
Well, and we've been hearing from non-bank companies, right, that lower income consumers are starting to get maybe a little bit more pressured, a little bit more choosy. How is that going to then feed through to the banks from everything from credit losses to deposit growth to loans and anything else?
Yeah, it's a great point. I mean, let's face it, consumers drive 70% of the economy. So if they're showing weakness, it is going to filter through to the rest of the economy. And fortunately for the regional banks, consumer exposure is relatively low. Most of the exposure tends to be residential mortgage and that credit quality. And we see that home price appreciation continues to be, mostly positive, except on the coast. But the home equity that's been built up should provide some stability and lessen any potential credit losses coming out of the consumer. I do also cover some of the neobanks, so Upstart, SoFi, Lending Club, Pagaya, and they do cater to a couple of them are at the upper end of the credit spectrum, SoFi and Lending Club, 725 to 750 type of FICOs. But Upstart and Pagaya, they're at the lower end of the credit spectrum, and we have seen some weakness in their credit metrics. So that's something to be mindful of.
And David, commercial real estate is another issue we talk a lot about here. What kind of challenge does that really pose for your coverage universe going forward? And are there certain names that are more at risk than others there?
Yeah, the ones that screen highly on commercial real estate, Comerica has more on the regional bank side. Even M&T Bank, which happens to be one of the names that we like, they have more commercial real estate exposure. I think that's why that companies coming under some pressure. On the mid-cap bank side, Home Street has a lot of commercial real estate. First Foundation, some of the Asian niche banks have commercial real estate exposure above average. So there are a number of banks that do have this exposure. That the good news with them is that time is on their side to build up provisions. It's not as if these maturities are going to all come in one quarter, like in the fourth quarter, for instance. Not going to happen. If that were the case, then we would see some severe issues. But considering most of these maturities should come in over the next few years, that'll give the banks some time to build up provisions to withstand some of the credit losses that may come through.
Well, speaking of building up provisions and changing capital, we heard, as we talked about, the large cap bank CEOs, sort of raising the alarm about increased capital requirements. What's the truth from fiction here? How onerous is it going to be? And what's the impact going to be on the regionals as well?
Yeah, so the proposed rules are contemplating risk-weighted asset inflation of anywhere from 5 to 15% for the regional banks. So it is a real issue, and of course that's going to pressure return on equity, right? Because then you're spreading out earnings across a bigger base. So there is definitely truth to the concerns out there, and it is eye-popping to see a company like JPMorgan seeing their, risk-weighted assets going up 30% and the capital requirements going up 30%. That does pressure their ROEs. They put up a great ROTCE of 22% this quarter, but when you factor in a 30% increase in capital requirements, that takes it down to 17%, which is their kind of long-term target. So it is a real issue for the banks.
And David, finally, you mentioned you like M&T Bank. I know you like Fifth Third and Customers among your top picks. What are sort of the commonalities here? Why should people be looking at these three going into the earnings season?
Yeah, particularly for Fifth Third, their commercial real estate exposure, especially since the hot button issue today, it's only 12% versus peers are upper at 20%. Also, when they spoke at a recent industry conference, all of the trends for the third quarter are looking as if they're going to come through at the better end of indicated ranges. So we're talking deposits, NII, fee income, expenses. It sounds like trends are looking good there. And then from a higher level, they continue to expand rapidly in the Southeast. And the Southeast market is a higher growth market. So that's good for them. Customers Bank Corp, one thing that they're doing that kind of stands out from the industry is their pipeline for non-interest bearing deposits is $2 billion. They expect that to come in over the next couple quarters. And why that's significant for them is that would represent a 50% increase in non-interest bearing deposits. And that would enable them to see some net interest margin expansion, whereas most of the group is seeing some compression. Now, M&T Bank, they're kind of a steady Eddie bank. They grow typically in the low to mid single digits year in and year out. Their capital level is well above the industry peers. Tangible common equity, 7.5%. The peer group is at 6%, and higher for longer, should benefit M&T since they are slightly asset sensitive. So their net interest margin, they're projecting, should stay above 3.6%, which is elevated for a regional bank, even if rates were to come down significantly. So there are a number of reasons to own some of the banks. We're cautious for the bank group from a high level, but we completely understand that many of our clients need to be fully invested. So these are some of the names that we point them to.
All right, David Chiaverini, thanks so much for your time, your insight, and those picks, David.
Thank you.